Hello everyone. Today's presentation is on the topic to improve financial forecasting in the future. This PowerPoint presentation is presented on behalf of my group, and my group members are Ansari Muhammad Bilal, Panam Vishnuvardhan Reddy, and Syed Kada, Yasir Ali, and myself Satish Reddy Sadhu. So in this topic we're gonna learn about the business organizations which use financial forecasting to plan for the future by estimating financial performances and results. Forecasting estimates future cash flow over months or years, like it's known as tenure. The financial forecasting tools include qualitative analysis, trend analysis, and budgeting. Quantitative predictions employ historical data and mathematical models. This strategy often uses time series and regression analysis. Trend analysis uses data trends to anticipate rather than typical statistical methods. And the inventory transactions are related to the cost of goods sold. The COGS, the company's cost of goods sold. The movement of inventory affects a company's cost of goods sold. COGS is the total cost of creating or buying a company's products in a certain period. Monitoring raw materials cost is a multiple step procedure on purchases, manufacturing, and also sales impacts the cost of items sold. So companies frequently record the initial purchase price of materials and finished goods in their inventory. These amounts starts as assets, not expenses. The cost of goods sold calculated by subtracting the end of the period inventory value from the entire inventory at the start of the period and all costs spent. That is, COGS represent the cost of inventory products sold to customer during the reporting period. This total includes direct material, labor, and overhead costs of creating or buying the goods. Cost of goods sold and Parsi's forecast. An inventory adjustment entry may be needed after an inventory count. This adjustment accounts for the gap between physical inventory on hand and accounting inventory. This modification might alter Parsi's financial outlook by increasing and decreasing inventory value, which affects the cost of goods sold. Parsis must raise inventory and make a negative entry to the inventory account if the physical inventory count shows more inventory than was reporting in the accounting records. An offensing credit entry is usually made to inventory adjustment or inventory overstatement. This modification boosts balance sheet inventories. And products could raise directly with inventory value. A higher value inventory adjustment indicates fewer things sold than anticipated over time. Lower cost of products sold boosts profitability. This adjustment may boost Parsi's predicted net income and profit margins. Parsi's inventory is devalued in the physical count, shows fewer stocks than stated. A debit should be entered into inventory adjustment or inventory understatement and a credit to the inventory account to fix this. If more goods were sold than expected, this modification would raise costs of Parsi's financial prospect may suffer if its reported profitability and net income are lower than predicted. Here is the table which shows the T count cash account to represent the changes in the cash balance. And now the forecasting error in the future. Any attempt to forecast or forces the future, whether in finance, economics, or elsewhere, will inevitably involve some degree of forecasting error. These blunders stand in for the gap between what was predicted or anticipated and what transpired. For this reason, decision makers and organizations must understand and control forecasting inaccuracies, imperfect or outdated information, market or customer behavior changes, or unexpected external events can create erroneous estimates. And the complexity of model system and forecasting assumptions can also generate errors. Remember that forecasts are not 100% correct, and there will also be some uncertainty in the future as well. So these are the references where we got the source from, and you can just have a look at these references. That's all for today. Thank you.